Today we're going to break down some really complex forces that are shaping our world. We're looking ahead to 2026, and a lot of economists and investors are on high alert. They're asking, is a perfect storm brewing for the global economy? And to really get why, we have to start with a number that's almost too big to even wrap your head around.
Here it is, $39 trillion. That is the U.S. national debt. It's a figure so immense it almost loses all meaning. But this isn't just some abstract number on a screen. No, it's the foundation of a system that's under enormous stress. And frankly, it's just the first of several major warning signs that are flashing bright red right now.
Just think about that pace for a second. $1 trillion of brand new debt in less than 5 months. This quote from the Independent Institute really nails the sheer speed of the borrowing. It sets a pretty dramatic stage for our story, right? It shows an economy where these internal pressures are building at an incredible and, some would argue, totally unsustainable rate.
Okay, now let's turn our attention to the warning signs that are coming from right here at home. We're calling this the onshore threat, and it really kicks off in the financial markets. And as you know, they often act as the canary in the coal mine for the wider economy.
For anyone who watches the markets, this is a huge deal. The 200-day moving average, think of it as the market's long-term health baseline. It's a critical floor. And for the first time in over a year, the S&P 500 has not just touched it, but broken right through it and stayed there. This signals a really major psychological shift where investors have gone from that buy the dip mentality to one of, aggressive caution. Now, what's so fascinating here is the convergence. It's not just one of these warning signs popping up. It's all four happening at once. Market veterans are pointing out that this particular combination, some are even calling it the four horsemen of a downturn. This mix has historically come before every single major market decline of the last 40 years. The alarms are definitely ringing.
And this chart just brilliantly illustrates the mood on the ground. Look at that spike on the far right. That is the Economic Policy Uncertainty Index, and it has shot past the levels we saw during the global financial crisis and even the pandemic. The research on this is really clear. Uncertainty acts like a tax on the economy. It causes businesses to hit pause on hiring and investing, and it makes families delay those big purchases.
So let's move on and see how this instability at home is getting cranked up by powerful forces from abroad. The problems, they aren't just contained within our borders. There is a serious storm, a squall, building offshore.
Geopolitics has thrown a massive wrench into the global machine. The closure of the Strait of Hormuz has disrupted over 20 million barrels of oil per day. That's a massive shock to the system. It's roiling global supply chains and creating this powerful headwind for the U.S. economy, all in the form of higher energy prices that hit every single household and every business.
And this brings us to a word that sends a shiver down the spine of pretty much any economist: stagflation. It is the worst of all worlds. You've got prices going up, people losing their jobs, and the economy just isn't growing. This is the nightmare scenario from the 1970s that a lot of people are now afraid could be making a comeback.
So with this storm building both at home and abroad, a critical change in leadership at the U.S. Federal Reserve, the institution that's supposed to be steering the ship, that adds yet another layer of profound uncertainty to the mix.
The nominee is Kevin Warsh. Now, he's no stranger to the Fed. He was a governor there before. But his nomination comes at such a pivotal moment, and he brings with him a policy vision that represents a dramatic and, pretty controversial pivot from the past. You can bet the markets are watching his every single move.
And this is the crucial point. It's the pivot. As you can see, Warsh was once known as an inflation hawk. He was the guy who consistently argued for higher interest rates to fight inflation. Now, he's signaling a preference for rate cuts. This has fueled all sorts of worries about the Fed's independence from political pressure at the exact moment when its credibility is needed most.
So, with all these powerful forces converging, you've got the debt, the market weakness, the global shocks, and a Fed in transition. What in the world happens next? Let's take a look at the potential paths forward.
Analysis from KPMG lays out 3 pretty distinct potential futures. The first one, their base case, is slowflation. So a slowdown, but not a total disaster. The second scenario is a mild bout of that dreaded stagflation we just talked about. And the third, the worst-case scenario, is a full-blown global recession with really deep job losses.
And these two charts, right next to each other, they show the incredibly painful trade-off that the Federal Reserve is facing. The pink line represents that worst-case recession scenario. On the left, you see GDP growth just absolutely plummeting into negative territory. But then look to the chart on the right.
That same exact recession is the only path where inflation comes down sharply. There are just no easy choices here.
This historical parallel from the 1970s, highlighted by KPMG, really serves as our final, stark warning. The economic mess of that period was capped by a geopolitical crisis in Iran, and it led to what people call a lost decade. Today, with so many similar ingredients in the mix, the stakes are incredibly high. A policy misstep right now could have consequences that echo for years to come. The question is, can we learn from history, or are we destined to see it rhyme?